Hi everyone and welcome to CT Connect. Today we're talking about two very topical issues for most businesses, tax and cash flow. With the current economic climate and also the IRD's increased focus on compliance, managing your provisional tax payments well can have a massive impact on cash flow. Today I'm joined by James from Tax Traders, a New Zealand company that specialises in tax pooling. James, tax pooling is a bit of a foreign concept for a lot of people. Can you help me simply explain what it's all about?
Yeah, absolutely. Thanks for having me. It's great to be here. I think to sum up tax pooling, it's probably worth noting that it only exists in New Zealand, so it's actually a truly Kiwi concept, which I think is really cool. And essentially what it allows you to do is, the government legislated this back in 2003, but you're essentially allowed to trade tax credits back in time. So you'll have clients paying original tax, standard installments like 28 August or the dreaded 15 Jan, which is just a terrible time for so many businesses to have to pay tax. And if you haven't quite paid the right amount, or if you don't have the cash available at that time to pay it, you can engage with a tax pool like Tax Traders, and you can purchase tax credits retrospectively or go back and buy tax credits. And what that allows you to do is removes you from IRD's painful use of money interest that they will charge if you haven't paid enough. And it will also reverse any late payment penalties that have been applied. So the savings can be quite significant. So we charge interest on the amounts of tax that we sell, but what we charge is significantly less than IRD. So it's a real money saver for the taxpayer, and it also can give them flexibility if they use it strategically. So if you decide you don't want to pay tax in 15 Jan because it's not the right time for you, perhaps because you're a seasonal business and cash isn't kind of readily available then you can wait until, say, April, May time, and you can purchase the tax you need at that point. And so it takes you out of that kind of like these hard deadlines that IRD put on you, and allows you to work your tax payments around when it works best for you, at a very kind of basic level.
Yeah, absolutely. And so I guess, some of the reasons that people might not be using their cash is they're looking at growth strategies, or there's a particular project they've got on at the moment. And so being able to manage when they actually have to come up with the cash
definitely
could be really helpful.
Yeah, totally. And also if you're in, we work with a lot of property developers, for example, and they don't know which year their income is going to arise in based on when sales take place and all that kind of thing. So for them, it can be quite difficult to forecast when provisional tax is going to be due and what's going to be due. And so knowing that they have the flexibility to defer that, or to come back and top up what they didn't get quite right first time round, gives them basically a second chance, and also saves them a bunch of money. So it generates flexibility, I suppose, and it's kind of a no-brainer, and it's generally seen as like best practice nowadays for taxpayers. I think it's probably fair to say when it started, the real focus for tax pooling was on the big corporates. And so when Tax Traders was founded 13 years ago, our founders Nicola and Josh really wanted to create a system that allowed all provisional taxpayers to get access to the benefits of pooling, not just the big bad banks and all that kind of stuff. They really wanted to kind of democratize that. So we've built a platform that makes that really easy to engage with. Advisors are often recommending it to their clients, and we have other things like direct data feeds, and we build solutions for accounting firms too, just to help make the whole challenge of the provisional tax ecosystem less difficult to engage with, because it is quite rigid, so and it can be difficult to get right.
It is really rigid, and I guess the other thing, thinking about industries that this might be really helpful in, is for example, like the growing industry, for example, or other industries that are really cyclical and, from a cash flow point of view, having those rigid dates can be quite crippling from a cash point of view and quite stressful. Whereas if they can manage their tax payments when they've actually got cash available, it can be a game changer. Yeah,
absolutely. So the agri sector broadly at the moment, cash is reasonably free flowing. Which is wonderful. It's kind of probably feels like it's about time, and so it's taking that opportunity when there is cash to make sure you're parking enough within the tax pool to basically cover what you might be exposed to, and then for those periods where things shift and perhaps you've paid too much tax, if you've engaged with a tax pool to do that, what it allows you to do is to access refunds within 24 to 48 hours. Rather than waiting until tax returns are filed and processed by IRD, which can take a really long time. So it kind of opens up different levels of flexibility for taxpayers depending on what their circumstances are.
Yeah, good points. And I guess the other thing that we're seeing a lot of, James, is that the IRD's increased focus on compliance is meaning we're seeing a lot of audit activity, a lot of reviews, which typically lead to audit activity. We're also seeing clients making voluntary disclosures, and so we've potentially got underpayments with the potential of an interest or penalty. So how would tax pooling, benefit a client in that scenario?
And it can benefit the client hugely, right? Because we're not just talking about a year's worth of interest now. We can be talking about 4 years worth of interest and penalties. So the answer is pooling can definitely help with that, and it's not just around income tax. It can help with most tax types. And so we've seen just a huge surge in the last 3 months in particular, but over the last 18 months broadly, of clients engaging with us to buy historic tax balances. So we hold tax all the way back to 2009. We don't get many people asking for 2009 tax, but it's there. And so when we sell that tax to taxpayers who need it, what it does is it reverses all of that painful IRD interest, and will also reverse late payment penalties if they're applicable. And the savings can be pretty staggering. And I guess this is an issue that's not going to go away. So over the last 2 years, there's been a 190% increase in the number of voluntary disclosures filed. It's just huge. And in the last year, from 24 to 25, the audit closures were up by 80%. So IRD are not going to take their foot off the pedal here, and I think that we can continue this kind of to see this environment for some time now. So what I would say is, if you think you're going to be in a situation where you're going to have a reassessment, make sure you're asking the question, could pooling save me here or save me some money? Because often it can do. So yeah, it's definitely something we're seeing a lot of.
Yeah. Look, thank you so much for your time today, James. Some really good insights. I think the big takeaway for me is tax pooling's for everyone. Tax traders and the like have made it available to everybody. It is becoming best practice, so the best way to manage your cash flow and also stay compliant with the IRD. So if that's something that really appeals to you and you'd like to consider something like tax pooling as part of your wider tax strategy, reach out to your CT advisor. We're here to help.